Hi, this recording is on the cash budget part of the theory here. And what we are going to do is we have to translate the income statement into the cash flow. Because what happens, the income statement shows the profitability for the business for 6 months or 1 year for a period of time, but it doesn't mean that the profits are all in cash. Some of the money to be received, they go in accounts receivable. So cash budget is a separate financial statement that keeps track of cash every month of the year. So let's see, we start with monthly sales patterns. So from January to June, this is how much this business is forecasting to sell in dollars. But again, this is not all cash because some goes into accounts receivables to be paid later. So out of all these sales volumes, based on this corporation analysis of past sales collection shows that 20% of the sales of the same months are collected in the current months and 80% goes in accounts receivables to be collected the following month. So in the cash receipts, this is how it looks like. From each month, so let's say January, we have 15,000 sales. We have 20% of 3,000 collected in January, 80% of 15,000, which is 12,000 collected in the following months. And you see they add up to 15,000. February, the same thing. 20% of 10,000 is 2,000 collected in the same month and 80% in the following months. And so on. So what we have here, if we add up these two elements, that's the cash coming out, cash in into my pocket for each month, total cash receipts. Okay. Now the next we are going to work on the cash payments. So because the cash budget is this cash receipts money into my pocket minus the cash payments that we have to pay lots of money for raw materials, wages, interest, expense, dividends, and so forth. So we are going to work on cash payments next. Now, first we are going to look into how much it's going to cost us to produce the goods. Remember, we have two goods, wheels and casters, and for each of the goods we have cost per unit, how many units we want to produce, cost per unit for each of them, materials element, labor and overhead, total cost for the first good, the same here, total cost for the second good, then we add those two costs, total cost for both goods. That's how much we have to pay for the production of the new units. And then we also have to consider administrative expenses, interest, taxes, and dividends, new plant and equipment. So we are going to consider all of these expenses, and there are some assumptions to be made for our business. To be easy to keep track of expenses, this business assumes that they have equal expenses for every month, for each month, which is really called the level production, which is smoothing out productions over the next 6 months to better deal with inventory changes, inventory build-up. This is what this business does. Consider equal amounts that are actually going to show here in average cost. So for the total of 6 months of materials from the previous slide, it was 34. If we average out, that means for the materials, the average expense per month is going to be 5,732. The same for labor, total divided by 6, average expense for labor, total overhead divided by 6, average expense for overhead. And now we are going to take a look at all expenses for my business. So we have how much cash I have to pay out from January to June for the 6 months for all the expense elements, starting with materials. We have, this is coming from the previous month, but after that we have equal amount per month. The same for labor costs, previous slide, monthly overhead equal amount. We made that assumption, level production is called. Then we add other expenses, administrative, And then we have taxes, quarterly payments of taxes in March and June. Then we have interest expense due in end of June, and also some big purchases here of new equipment. One 8,000 in February and one 10,000 in June. And I think I forgot to mention the cash dividend expense here. So now, considering all these expense elements, so if you add these numbers, cash out is 11,000, the same here, all the expense elements. So this is total payments. So on the next slide, we are going to do the cash flow, cash budget. Cash receipts minus cash payments. This is what it is. Monthly cash flow, difference between cash receipts and cash payments. And this is what we have, net cash flow. Cash receipts minus cash payments. Positive, negative in February because we had that equipment of 8,000 purchasing, big one. And then negative again in March, April, May, positive. And then again in June, we have so many expenses in June. Equipment, dividends, taxes, interest. This is why we have so big negative cash flow. So that means that out of 6 months, we have to borrow money to make these payments for these 3 months. This is why the forecast is very important, to be able to forecast in advance how much we need to borrow to meet the expense requirements for these 3 months in this example. And this is what we are going to do next. We are going to incorporate the borrowing to meet the expense requirements. Now, there is an assumption, not an assumption, a law that businesses follow. They always keep a minimum cash balance at the end of the day. In this case, consider that our business wants to have to end up every single day with 5,000 in the cash. So that means if any month, any day they are short, they have to borrow more than they need to end up with this 5,000. So let's see, we start with net cash flow. That's all these numbers are coming from the previous slide. You see here, those are the numbers for net cash flow that are going to be transferred here. Net cash flow from January 1380. We assume we have beginning cash balance here because it's required here. And then we end up with cumulative cash balance, these two numbers added up. And this is my ending cash balance. This is going to be transferred over here, beginning cash balance. This one is coming from the previous slide, net cash flow. So the difference, net cash flow, and this is a negative number, and we have positive beginning cash balance. We have 72 in red, so we have to borrow 5,072 to cover this 72 and end up with 5,000 at the end of the month. That's required. Now this one is going to be transferred here. Negative cash balance, cash flow for March. That's positive. We have a positive of 1,045, but again we have to end up with 5,000, so we have to borrow this much. This amount plus this amount add up with 5,000. And this is the cumulative cash balance for the year, which is this amount we borrowed previous month plus this amount we borrowed this month. That's cumulative money borrowed. Now again, this one is going to come up here. Net cash flow is over here. Now we have a 9,000 positive. And how much we can repay my loan? Well, as much as I can to end up with 5,000. So 9,548 minus this is how much I repay. So I end up with 5,000. I still have a cash balance. This is going here. Net cash flow here, total 15,000. I repay everything left over, so I end up with 11,000. No loan outstanding at this point. But it's not going to last long because I have a big negative cash balance here, end up with 886. So I have to borrow 5,886 to end up with $5,000 requirement. So next we are going to work on applications on the cash flow. I'm going to work on a new recording with that.